Hi, this is Jim. Welcome to our Credit Suite webinar today. Today we're going to be discovering how your consumer business credit and your bank credit scores really work. I know that you're all used to seeing Ty on here, so I just wanted to take a moment to introduce myself. I'm Jim. You can reach our team here at Credit Suite at info@creditsuite.com. And I've got a great informative 4-step guide on building business credit right here at www.creditsuite.com/EIN. So when we do that, we're going to talk about consumer credit scores. And when we look at consumer credit scores, nearly all adults have a credit score. You get one basically when you have credit that's been reporting for at least 6 months. And now you get credit really when you apply for credit, apply for a credit card, borrow money from a bank, buy real estate. So anyway, you're going to get a consumer credit score, or what we call the FICO score. Now on your FICO score, what we're talking about is really an algorithm. It's a mathematical model that they've come up with, and what they're doing is they're using it to depict your risk of going 90 days late on an account within the next 24 months. So when they're looking at you, they're coming up and they're putting many mathematical formulas together, an algorithm again, if you will, to depict your risk of going really late in the next 24 months. So the personal credit scores really are based on mainly the 5 factors. As probably all of you know, the main one is your payment history. Are you paying your bills on time? So well over a third of your personal credit score is going to depend on you paying your bills. The second, and almost equally, is utilization. I know we've all seen as you utilize your credit score goes down, you get access to even less credit. Now, also playing a major part in that is the length of your credit history. One of the biggest mistakes I see people with their personal credit is closing out aged or old credit accounts thinking they don't need that. What that does is shows on your profile, the older credit, the better you have. The other is accumulation of new credit. Are you getting new credit? And again, another 10% is what they call a credit mix. And when I'm talking about a credit mix, I'm talking about a mortgage, installments, credit cards, other revolving lines of credit. So underwriters like to see a mix, and that really helps your credit score, the agencies, when they see a good mix rather than all credit cards or just a mortgage or just an installment loan. Now, most of you probably already know that the main 3 credit bureaus are Equifax, Experian, and TransUnion. So TransUnion is a consumer credit only. Now, Experian and Equifax both have consumer and business divisions, and we'll look at the difference between both of those in this webinar today. So there are many other smaller reporting agencies. Probably you've never even heard of a lot of them, but really it's the big 3 that matter a lot more. So that's why we always know Experian, Equifax, and TransUnion. Now, in doing credit scoring numbers, you get what's called a personal FICO score. Now, in a personal FICO score, these scores are ranging from 350 to 850. Now, the old Vantage model used to range anywhere from 501 to 990, but now they've come out with Vantage 3.0, and the Vantage 3.0 is the 300 to 850 model. So that's what TransUnion is using now, as TransUnion actually uses that Vantage 3.0 model. So as you can tell from the previous slide, what we're doing is we're running from the score of 300 to 850. Now, and scoring through the Vantage scoring system here, a 781 to 850, it gives you the A grade on credit. Now the bottom end or the lower end, you know, is going to start at 300 and go to 600 for the F credit. So your your B, C, and D are all going to be between that 600 and that 781 as you grow there. So here's how TransUnion is broken down. We saw how the FICO is broken down. TransUnion places an even bigger importance on your payment history. Full 40% is really put together on your payment history. So consequently, they pay a little less attention to credit utilization. So you see credit utilization has dropped from 30 to 20%. And then your credit history basically remains about the same, 21%. And basically now your reported balances, keeping high balances, that's going to be 11% of your score. Getting new accounts will drop from 10% to 5% on this. So when you're looking for a business credit score, we're also looking at what I consider an algorithm or mathematic model. And it's used to depict the business's risk of going 90 days late on an account, not within 24 months, but within the next 12 months. So you see the business credit is basically, the algorithm is basically going to be half of that. The three big credit reporting agencies, again, remember you have Experian and Equifax that do personal and business. So replacing TransUnion as the big one on the business credit side is going to be Dun Bradstreet. Dun Bradstreet is going to be just for business. And as we talked about before, Experian is both business and personal, and Equifax is both business and personal. Now, again, in business credit, there are many other smaller credit report agencies that just aren't checked as often. Now, we at CreditSuite know that Dun Bradstreet, Experian, Equifax really are the ones that matter a lot more. We also offer business credit monitoring. I'll touch on this for you at www.creditsuite.com monitoring. Dun Bradstreet will charge you just to monitor theirs. They will charge you $159.95 a month to monitor your business credit with them. Experian will charge $49.95 or $50 a month. So right there you have almost $220 in business credit. At www.creditsuite.com/monitoring, I can monitor both of these for $24. Now, your business score is something like your consumer score is always automatic. You know, all you do is you go, you open something, it's reported to Experian, Equifax, or TransUnion. Now, your business score is a little different. You have to apply or register. More specifically, you need to get a DUNS, a DMB. You know, basically, you go to Dun Bradstreet to get one of these. You've heard them as a DUNS number, a DMB number. They are required by law to send you a free number. The other thing that you need to do is you need to get an EIN from the IRS. Again, another simple and free number. If you need an EIN, you go to irs.gov and you fill out Form SS4. And you can do that on the internet and you can get your EIN. Again, a free number. I know many other people charge you money to do this for you, but it's very simple and easy to get. Now, Dun Bradstreet will start tracking your business's financial activity right from the beginning. If you don't register with them and you do business with someone that reports to Dun Bradstreet, Dun Bradstreet will not accept the information because you're not registered with them. So this is why you need to go and apply for your DUNS or DMB number so that when you do work with creditors, you can build your business credit because you're now registered with them. Dun Bradstreet gives you what's called a PAYDEX score. And I'm going to go a little bit into what you get with the PAYDEX score. Again, you see down here, you can get an informative 4-step guide by going to www.creditsuite.com/EIN to help you get some of these hints and tips on building business credit. Now, when you're looking at business credit, these scores are strictly in the business name. These are not in the business owner's name. They are not in the consumer name. They are registered to the business and leveraged by the EIN. Now, business credit builds its own credit profile and credit score. So now you have a completely separate score from your personal score, from your personal FICO score. And I'm going to talk about some of the differences in scoring as well. So with established credit profile and score, your business is now able to qualify for bigger lines, more available credit, and actually work with more vendors. So this measures the business ability to pay and not the owners. Again, two separate wallets, a FICO score and a business score. So most of the major businesses are going to rate you, instead of the 300 to 850 that you get on the personal side, most major business credit scores are going to generally range from 0 to 100. So when we're looking at those, we look at the personal FICO scores, and then we look at the business scores. So the consumer reports basically show one score per bureau. So you'll get a 632 at Experian, you'll get a 687 at TransUnion. Now business score, you'll have multiple scores. So they'll show multiple scores per business. And we're going to go into some of those and what they are. The primary score, like a PAYDEX or Intelliscore. There are other scores, and you've probably seen a business report and you said, what's SER mean? What's SSI mean? What are we looking at when we go through that? When we go to Equifax, what's a small business credit risk score for suppliers? And what does it mean on a business failure score? So if you haven't seen these, obviously you can use www.creditsuite.com/monitoring. You can, again, monitor your PAYDEX or D&B score. You can monitor your Experian Smart Business Data Score, and you can do all this for $24 a month. Literally saves you almost $200 a month over going to Dun Bradstreet, Experian themselves to monitor the very same information. So the process data, Dun Bradstreet, is all about your company. And what they're doing is they're checking for accuracy, completeness, timeliness, global consistency. Basically, I've seen and worked with many. We've worked with thousands and thousands of businesses at CreditSuite. We've never seen a business pass a consistency test or an address test. There's always been something wrong with the address, and the people come back and say, I can't build business credit. The underwriters are finding things. So accuracy, completeness, having a business address, business phone, looking like a business to the underwriters is going to get you more credit. So what Dun Bradstreet reports are really going to show is that your payment records, the upper credit limit, they're going to show the net worth or estimated net worth of your business. They're going to show current assets, and there's even more. What I want you to know is just not agencies can pull this. This information is all public knowledge. Other business owners, even individuals, can pull this information up. So this really puts your business out to the community. I also always advise other businesses, if you're going to work with another business, pull up their Dun & Bradstreet report. Take a look at them. See if they're reputable and they're going to be in business when you need products or services from them, or if they're even going to pay you if you're doing products or services for them. Now, D&B is going to look at many different factors. One of the first things that any credit agency or monitoring ever looks at is really bankruptcies. Obviously, with bankruptcies, it's shown an inability at some point in time, the inability to pay. The same with liens. Liens against your company, tax liens. Again, showing an inability to pay the obligations that you've made. The other thing in today's litigious society is lawsuits against your company. Now this is any lawsuit, and you know anybody can go out and file a lawsuit against anybody. So this is going to track all lawsuits, and that's why I always say, if you can, try to settle out of court. You don't want any information on lawsuits on your profile if you can avoid it. Very next thing, obviously, your credit card payments. Timely payments, as you saw on the personal side, played a very, very important role, 35 to 40%. I'm going to show you how much bigger role it plays in your business credit. Again, your bill payments, same thing. This is going to play a very large part in paying your bills on time and building your business credit and getting access to more and bigger capital. And they even look at more and more things. So when we're looking at D&B, as I mentioned, the consumer rating runs basically from 300 to 850, and then your PAYDEX, as I mentioned, for business is generally going to range from 0 to 100. The 100 here is going to be the absolute best that your business can get, and really what a score of 80 or higher is considered good or healthy credit for a business. Now, a business can get good business PAYDEX credit by ensuring what I've been talking about, payments made promptly to suppliers and vendors. Because when you look at a good PAYDEX score, as I mentioned, 80 is favorable or good credit, which is going to get you the most favorable rates. It's going to get you lower rates. It's going to get you higher capital lines. So what I'm saying is this says that this business pays their bills on time. So to get a PAYDEX score, you're going to need at least 5 trade accounts reporting to that file. Once you get the 5 trade lines according to that, you can build that PAYDEX score. Now, it can take up to 90 days for those trades to report. As you go through, you actually use the credit, you buy the product, you pay for the product reports to Dun Bradstreet, Dun Bradstreet posts that. So I just want you to know that from start to finish can really take up to 90 days, and then your score will be established. Now, larger businesses or business been around, it can literally be calculated by as many as almost 900 payments for their business. So when you go about your PAYDEX score, what it's going to come down to, it's going to come down to a weighted average. And what I mean by a weighted average is the trade accounts with the higher dollar amounts are going to be weighted bigger than the smaller dollar amounts. So what I'm saying is, and I've seen a lot of businesses do this backwards, to keep a good business PAYDEX score, you pay the biggest one first. So if you've got a $5,000 trade line, you've got a $700 trade line, and you have $500 to pay today, and you say, oh, well, I'll just knock off this $700 trade line. No, go to the largest trade line, pay that first, because with the weighted average, it's going to build you better, bigger business credit faster. So as we've already talked about, bankruptcy is a problem. So I told you about looking at the SER. What does SER on my Dun Bradstreet mean? And what it stands for, it's an acronym, meaning Supplier Evaluation Risk Rating. What this is going to do is it's going to predict the likelihood of a company to file bankruptcy and cease operations within the next 12 months. Remember, we were looking at consumer credit, we're looking at the likelihood over 24. So now this has completely unique scoring. You know the PAYDEX score is rated from 0 to 100. Now your SER score is going to be a much smaller score. It's going to be on a range of 1 to 9. Now in this case, 1 is going to be the lowest risk, and 9 is going to be the highest risk. So if you've got a 9 or you see a business with a 9, there's a very good likelihood that bankruptcy and ceasing of operations is very likely to happen within the next 12 months. Now, the other unique lettering that you've seen on there is probably SSI. And no, it's not Social Security. It's Supplier Stability Indicator. And what this is, just like the name says, it's going to talk about stability. So what this is going to predict is that the supplier will encounter either financial or operational stress. And now look at this. It's over the next 90 days. So consumer credit, we were looking at the likelihood to default or 90 days over a 24-month period. Then we went to the likely to default in a business credit over 12 months. Now we're looking at significant operational or financial stress over the next 90 days. Again, like SER, you saw the scoring was 1 to 9 with 1 low, 9 high. Now we have another unique scoring ranging from 0 to 10, 0 being the lowest risk, and again, 10 being the highest. So now what we're doing is we're rating this business, the likelihood will encounter a large and significant financial operational stress. So if you're looking from that supplier and you see they're at a 10, there's a good possibility that your order may not be delivered because there's financial or operational stress at that company. So let's take a look and dive from Dun Bradstreet, D&B. Let's go to the Experian Commercial model. And Experian uses an absolutely huge database, and they do proprietary or their own analytic software. So they have their own algorithms or mathematical formulas that they're putting toward this. Now, their reports are really going to include a myriad of things. They're going to include scoring, trade information, financial history, court judgments, and uniform code filings. So a lot of you may know what UCC filings are, but what they are is there's something that's filed anytime a business is looking or taking out credit. So it's not necessarily a derogatory remark. It's merely a statement that they're looking for. Again, I wanted to just point out that you can always get this monitoring of Experian, Dun Bradstreet, www.creditsuite.com/monitoring. And again, I'm sure that you can use that $200 a month for the same information or $2,400 a year to invest in many other things in your business. So when we look at the Experian, they're going to use what's called an Intelliscore. So we had the PAYDEX score for Dun Bradstreet. Now we're going to use another proprietary scoring system called the Intelliscore, and it's going to range from 0 to 100. Now, percentile scores, they're going to reflect which businesses do better or worse than the one under scrutiny here. So we're going to take a look at that. So new Intelliscore Plus is using over 800 aggregates or factors. So when I talk to you about a database and factors going in, there's a lot of intricacy in the algorithms or mathematical formulas that Experian is using to calculate your business credit. So let's take a look at Experian's methodology and how they do that. Now, when they look at data segments, they're going to look at firmographics. Now, yeah, it looks fancy, big word. Merely what firmographics is, it gives the descriptive attributes of the business. It's telling you who their customer is, how much they spend. Basically, it's the demographics of a business when you're looking at that. So when you think firmographics, it's the demographics of the business. Who's the avatar? How much are they spending? What's the size of the business? Is it like other businesses in that sector? So look at that, public records, collections, and trade information. Now you put each business in one of these three models, and they're basically going to be small, medium, and larger businesses, so it's very easy to see. But what's really unique here and what I really want to show you is the blended or owner model. So the commercial data is now linked with the owner's information. So we have a unique model here. So the Intelliscore Plus will give them a percentile score. And again, what we look at when you're looking at Intelliscore or anything, remember it's based on payment history. So payment history, but there's other factors. As I told you, there's over 800 factors that are going into these percentages to give an overall score. But when we look at it, let's take a look at how it breaks out. If you think back, remember, consumer credit, payment history, 35, 33%. Now when we look at this, historical behavior is only 5 to 10% on the Intelliscore. But what I really want to point out is look at your current payment status, your trade balances, percents of accounts and delinquencies. This is now making up 60% of your score. So payment history and being on time is absolutely crucial to create a good Intelliscore. And personal or FICO or personal credit, you're not reported late until after 30 days. And business credit, you can be reported late in as little as 1 day. So it's very important that you keep up your payments and you see what a huge impact it'll make on your Intelliscore. Now your credit utilization, as you noticed, was 20 to 30% on the personal side. At this point on this side, it's really only 10 to 15% of your total score factor. So you can see your utilization of credit is a lot lower. It's really based on your good payments. So you can use your credit, you can use a lot of it as long as you pay it and you create a good Intelliscore and keep that Intelliscore up. Now the company profile, when we're looking at that, I'm sure you've all talked or know about aged corporations and how they get preferred treatment. Also comes down to risk of industry. The size of a business, is it small? Smaller business, as you probably know, has a much greater risk of going out of business. That's something that's established a long time, has low risk, and a lot of employees. The other thing is, again, derogatory remarks, collections, liens, judgments, bankruptcies. Again, I tell you to avoid lawsuits as much as you can. Collections, that's all good payment history. Now, on Experian, I know you've all experienced or heard that on bankruptcies, personal side is 7 years. Look at this. Bankruptcies on Experian business are going to be there for 9 years, 9 months. So essentially 10 years of bankruptcy is going to haunt a business. Now, judgments, tax liens, and collections are all 6 years and 9 months. So again, closer to that 7-year period like on the personal side, but they can all haunt you for a very long period of time. I know that I brought up uniform commercial code filings. They remain on the profile for 5 years. Now, bank, government, leasing data, that's a 3-year on there, and as long as your trade data. So we've taken a look at a lot of information on Dun Bradstreet. We've gone through Experian, seen the differences in scoring. Let's take a look at Equifax. So Equifax business, what they collect is they're going to collect, look at this, utility account information. So this is something you've not seen on the others. Trade vendor data. Again, as always, bankruptcies, judgments, lawsuits, and liens. And then I'm sure you've probably seen the acronym SBFE, or Small Business Financial Exchange. So that's where they're getting a lot of information when they use their algorithm or mathematical formula of moving forward on how to build business credit. So what Equifax business is doing, they have a credit risk score, and again, we're going to predict the likelihood of the business incurring a 90-day severe delinquency or a charge-off of that over the next 12 months. So we're looking, what's the likelihood that something's going to be charged off in 12 months? So now business failure score, is going to predict the likelihood of business failure through either formal or informal bankruptcy over the next 12 months. So you get what's called a payment index, and that provides a dollar-weighted index of businesses' current and past performance based on all payment experience in the Equifax Commercial database. So the Equifax Small Business Credit Risk Score now is going to predict the likelihood of a business incurring greater than 90 days severe delinquency or charge-off. And that, again, remember, is in a 12-month period. So again, the difference, consumer to business, is 12 months. Consumer is 24, business is 12. Score is built using financial services. There we're looking at trade payments, we're looking at data, we're looking at anything that's going to help provide a higher degree of predictability. Now, the Equifax Small Business Score, this is where it's a little different. We're going to come up with a score of 101 to 992. So again, a proprietary score. So, and it returns up to 4 reason codes on that. And the most popular or the most easy code is a 0, and that indicates a bankruptcy on that. Now, the Equifax Business Failure Score is going to predict the likelihood that this business is going to fail within 12-month period. So it was built, trade data, again, financial services to get a higher predictability. Now this Equifax Business Failure Score, again, has its own range, and it's going to range from 1,000 to really 1880. So we'll take that little A out of there, 1,000 to 1880. Again, it returns 4 reason codes, and as you remember from the previous slides, a 0 is going to mean a bankruptcy. So when we go to a FICO or SBSS, our Small Business Scoring Service, this is what the SBA is going to use. So we're talking about the blended. So when we're talking about the blended, that's we're looking to see what the likelihood of this applicant of paying their bills timely. And I'm sure you've heard me beat on that, timely payments. The scores in this are, again, different. They're going to range from a 0 to 300. In this, the higher score is going to mean a lower risk. So a 300 score here is going to be good or low risk, and the 0 is going to be bad or a higher. So that higher score, again, is going to be a lower risk. The higher you score, obviously, then it's going to be the better. So now, speaking of the blended, your personal and business credit history plus all the financial data go into total calculation of this score. So when SBA is reviewing this score of 0 to 300, you can be assured that as you get closer to 300, that's what SBA is looking for. As a matter of fact, with a score of 140 or below, you're not going to be approved. And generally, they're really looking for the cutoff at 160, 170. So they're really looking for you to have a decent SBSS score. Now, below this number, might as well be getting ready for being denied, because it's indicated through that SBSS score that you are at high risk. And the chances that the SBA lender won't even submit that application because it doesn't meet the minimum requirements that they're looking for. So, and talking about that, the FICO SBSS is going to take into account obviously your personal information. So we're going to go into your personal credit. Remember the blended. So now they want your business credit, hence the blend of your personal credit and your business credit. Also comes into play is the age of your business. How long have you been in business? Obviously, the numbers say that most small businesses fail in the first 3 to 5 years due to lack of capitalization. Once you've met that threshold, it's usually a good bet that you're going to remain in business. So that's what they're looking for. Financial details, cash flow, revenue. If you're generating no cash flow or revenue, there is nothing to say that you have the money to pay back loans that they would give to you. So financial details are very important at that. So if you have no cash flow or revenue, just be assured that you're going to have a very low SBSS FICO score. And these scores are going to range very much like the Vantage 3.0 model, 350 to 850. So again, just want to bring up to you here, if you want some hints, tips, and tricks on building your business credit, you can go to www.creditsuite.com/EIN and get this informative guide that will help you. So let's look at some of these combos. The SBSS data combos. So the small business credit issuers get different combinations of data so that they can evaluate the risk of a business. You know, they could just use Experian. They could just use PAYDEX. They could just use Equifax. So, or it could be a combination of all of them. So if there isn't enough data, SBSS defaults to using strictly the owner's personal data. So if you're a personal owner and your data is lacking, again, this is another way that's going to kill an SBA deal. So in doing that, this credit offer index is really designed to help issuers know how much to lend or the capacity of you to pay back. So what we're going to take into account, again, you know, we're going to look at the revenue that you're generating. Do you generate enough revenue that you can pay back a loan? And then you're benchmarked against businesses with similar profiles. So businesses in the same industry, businesses of the same size. Again, this is where that firmographics that I went back to. Who's the customer? How much do they spend? Where do you rate as far as business to your size? So that's some of the data that's going to be up here. Also application data, financial info, the Consumer Credit Bureau as well as the Business Bureau data as well. So that's where we're getting all this blended information, and that's why we have this blended credit, and that's why this is a little tougher to decode and why we're going over it today. Now, what they're going to give is, again, it's going to be a percentile ranking, and it's going to be benchmarked on other similar businesses, plus the amount of money that you request. You know, I've seen a lot of businesses request more money than they have the ability to really pay back, and that's a quick way to get a denial. It's not a negotiation, it's a yes or no with underwriters. So when you do that, make sure that you're using the right data to do that. So now it can be used whether financial data was supplied as part of the application. So we even discussed that, and can default to the business owner. And then it can be used by credit issuers to see if the requested amount is in line with previous experiences they had in the industry and the size of business. So again, what I was talking about before was requesting the right amount of money, and whether getting approval or denial, there's not a maybe, there's not a negotiation, it's a yes or no. So you've got to get in line with what's being done previous with that. So how do we lower a business credit score? I think some of the things are really obvious. Tax liens, other liens, collections, judgments, bankruptcies, any derogatory information provided in that file would definitely lower a business score, which makes it hard to increase the capital limits or access to capital that you'll have. So, you know, we're looking at really, you know, what's the status? What's the frequency? I mean, are you going in the red a lot? Is this a one-time thing? What's the applicable liens? So is there showing a trend where you're increasingly late on your payments? Remember, personal, you not reported late until after 30 days. Business, you can be reported late in as little as 1 day. So, do we see a trend in slow payment of obligations that'll lower your business score? What about number of inquiries? Inquiries always go up when businesses have their back against the wall and they're looking for any avenue for help. So when you see an increase in inquiries to an underwriter or monitoring agency, what it looks like is a cry for help. And that immediately raises that red flag and can really lower your credit score because they're thinking that you're really going into stress or out of business if you don't find the credit that you're looking for. Also, the number of trade experiences definitely is a big source in getting and growing the capital limits you can in business credit. I see people go out and get 3 trade experiences and they wonder how come they can't go out and get loans or credit cards. You need trade experiences. 10, 12 trade experiences will get you into cash resources. So outstanding balances, your payment habits. Remember, I've hit on payment habits the whole time. Make sure you pay your bills on time. We talked about credit utilization, though a little smaller factor on business credit. It still is a 10 to 15% of building your business credit, so you don't want to overutilize your business credit or trend to. And then we go back to the statistics of the business. How long have you been in business? What is your line of business or your SIC code or NAIC? How big is the business? Or the other demographic data that we talked about in the firmographics. Who's the avatar? So when you go and you're looking at bank credit scores, now a bank credit score is something completely different in that it's the total amount of borrowing capacity a business gets from a banking system. I know the banks always turn me down. Well, what this is it's not the same as business credit. Business credit has a much broader reach, much broader risk of lenders. It's got your suppliers, it's got your credit card issuers, it's got your equipment leases, it's got your basically who you do business with or supply business with helps build your business credit, whereas a bank just has the one. So it's a much broader reach. Now a business can get more business credit much more quickly as long as it has a minimum of a bank reference. And the average daily balance of that bank for the past quarter or 90 days is at least $10,000. Now what this does is this will yield what they call a bank rating of a low 5. A low 5 meaning the adjusted balance of $5,000 to $30,000. So if your bank is holding lower, you're going to get a lower rating or a high 4, and this balance is the 7 to 10,000. Now this won't stop a business application, but will certainly slow down the approval and have the underwriters take much more scrutiny of your business to be able to make sure that you'll be able to pay that back. So, and if we do a high 5 in the bank rating, so I'll go through these real quick. High 5, your account balance over that 90 days is basically going to be $70,000 to $100,000. So that puts you in a high category. Now the mid 5 is just below that at $40,000 to $60,000. And as we talked about, the low 5, which really is the threshold of making sure that you do get credit or capital for your business, $10,000 to $40,000. Now, we did discuss that a high 4 at $7,000 to $10,000 will not completely preclude you from getting the business credit, but it's certainly going to slow down the process. It's certainly going to put your business under much more scrutiny to get higher and bigger capital. Now the mid 4, now $4,000 to $7,000, There may be a lender out there that can help you, but they're getting few and far between. And if you're at $1,000 to $4,000, you're generally going to have to rely on the generosity of friends, because banks aren't going to be looking at the low fours. So when we do these bank ratings, to keep the bank ratings up, keep at least at $10,000 in an account over a 90-day period. Now, money should be kept there. One of the things I see a lot of businesses do is they pull the money out of the bank as fast as it goes in. That's not a way to make sure that you keep high bank ratings. So that money should be kept there to ensure the rating remains high. Now, each cycle, or the 90 days, is based on the previous month. So every 30 days, a month falls off. So if you had a bad month where you had low deposits or low amount in the bank, that's going to fall off in 30 days. And now we can look at the next 90 days. So that cycle, if you have the great cycle where you're keeping at least at 10,000, now you've put yourself in much more lendable position. So it's basically based on the previous 3-month period. Now, before a business decides to apply for that credit, it should make sure that, as we went through, it has the low 5 rating for the last 3 months. That's going to put you in at least a lendable position. Again, remember, the high 4 may not preclude you, but it's certainly going to slow down. So we want to make sure that you keep at least at 10,000 in the bank over the last 90 days. So some of the other factors in looking at banks, and you know, a lot of underwriters look at these when they're looking to give capital, is they're going to look for negative days or NSF days in the bank. To me, it's a no-brainer. If you're carrying a negative or zero balance in your account, how can a lender expect to be paid back? What are they going to pay? How are you going to pay them back if you're negative or zero in the account? There's no money for the payback. So this is going to be looked on as a way not to get money. So they're looking for positive cash flow. One of the other things that really diminishes the risk is consistent deposits. When you have consistent deposits into an account rather than sporadic or periodic every 2-3 months, you make yourself much better risk. So you're much lower for them. The other thing is obviously the age of the account. So if you've had your bank account open for 7 years, it's going to be much more positive than you opened it 30 days ago. And believe me, the underwriters do sniff these things out. And what products do you use at the bank? Do you use just the checking account? Do you use a checking and savings account? Are you part of the money market account? Do you have loans? So it's going to look at the series of services that you use from that bank. So any savings account or investment that a business has, so they will look at everything. But remember, the one thing that I keep talking about, keeping your scores up, payment history. Payment history is important to all the scores except bank credit. Because remember, bank credit is not looking at payment, it's only looking at how much money and how much money is going through. So other than bank credit, your payment history is huge. The next thing that we've always talked about is utilization. Keeping your utilization down so that you have access to even more credit is going to be a way of keeping your scores up. Again, the length of credit history for business and time in business is going to be another huge factor. And then if you really pay close attention, patient, grow your history, concentrating on these areas is really going to produce the most impact in the fastest amount of time. So when we're looking at doing that, keeping your scores up, keep money in the bank over a 90-day period. Don't go in, put the money in, pull all the money out because you don't want your money sitting in the bank. The underwriters are looking for black and white. They're looking for what it says on paper, looking at those statements. So if you want to stay in a lendable position, keep that $10,000 balance or better in that account, and make sure you keep up the positive cash flow. Because if you keep that positive cash flow and keep out of those negatives or NSFs, they're going to see that you have the ability to pay back loans, and that's going to put you in a much lower risk. Now, a lot rides on your business payments history. You know, I know I've emphasized this all through this entire webinar, but when it takes basically a third to 60% of your score relies on this payment history, you can see how important it is to pay your debts on time. It has a huge impact on your business score. Now, just like the personal side, you really shouldn't use much more than 30% of all available business or consumer credit. Now, that being said, remember that when you build business credit, you're leveraging a business instead of a single individual. What that does is actually allows you to have credit basically 10 to 100 times bigger than what you get on the personal side. So if you can get 30% of something that's 10 to 100 times bigger, you can see how important it is to pay this on time, keep good payment history, and pay your debts so that you get those higher credit lines. And as I mentioned already before, be patient. Allow the time to lengthen the credit history. Don't close out credit history. It's one of the biggest mistakes I always see. And time in business, you know, you see many businesses close their doors and reopen. Make sure that you do all the right things to keep your doors open, to give you that longevity in business. This will help you get access to more capital rather than starting over and scratching again for more capital to open another business. It's much easier to keep one open. Now, remember to keep the money in the bank, positive cash flow, and avoid the NSS. It's been really my pleasure to be with you today to do Credit Decoded. Really a lot of tips and strategies I've taken from Ty Crandall, who's our CEO here at CreditSuite, his book Business Credit Decoded. To contact us, more information, you know, you've got the number here, the 877, and then you can also email us at info@CreditSuite. And I do want to bring up to you, save yourself a lot of money. This is the same information you're getting on credit monitoring that you get from Dun Bradstreet for $160 and Experian for $50, or combined $210 at www.creditsuite.com/monitoring. You can get that same information for really $24. I want to thank you for spending the time with me today, and I wish you all continued success.